Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Thanks for having me. It's a great time to be looking at the markets.
It really is. And, today we are looking at something that honestly feels a bit like a Wall Street mystery.
Oh, absolutely. A huge mystery.
Right. So we're looking at two absolute titans of the financial world, two of the greatest investment firms out there. And they are looking at the exact same data, the exact same economy, and the exact same $4.8 trillion tech giant.
We are talking about Alphabet, right? The parent company of Google.
Exactly, Alphabet. And according to the brand new Q1 2026 filings, the data shows they just made completely wildly opposite moves.
Like polar opposite.
Yeah. On one side, you have Berkshire Hathaway. They basically went on a historic shopping spree, just buying an absolute mountain of Alphabet stock.
Backing up the truck, basically.
Backing up the truck. But then on the other side, you have Stanley Druckenmiller's legendary family office. And they basically smashed the panic button.
They really did. They sold every single share they own, just completely zeroed out their position.
Which is crazy. For anyone trying to, build their own portfolio, seeing the absolute best minds in finance look at the exact same company and do completely contradictory things, it's incredibly confusing.
Oh, it's overwhelming for a beginner.
If the pros can't even agree on whether the biggest search engine on earth is a buy or a sell, it leaves you wondering, what are you supposed to do with your own hard-earned money?
Well, it looks like a contradiction on the surface, but it's actually a masterclass.
Masterclass in what, exactly?
In how different time horizons and different risk levels completely change how a stock is viewed. Because, this isn't really a story about who is right and who is wrong.
Right. It's not a competition where one is a genius and the other's a fool.
Exactly. It's about the specific game each investor is playing, the macroeconomic weather they are looking at, and really the shifting foundation of the entire tech industry right now.
Okay, let's unpack this, because I want to translate these billionaire moves into simple, everyday lessons for you listening at home.
That sounds like a great plan.
But before we get into the why of it all, we really need to look at the raw data. Like, what exactly is Alphabet today?
Good idea. We need to set the stage.
So, according to recent analysis of those Q1 filings, Berkshire tripled their Alphabet holdings. They now own about 58 million shares.
Which is just a staggering amount.
Yeah, it's roughly $23 billion, a massive concentrated bet. And to fund this, the data shows they completely sold off massive stakes in Visa, MasterCard, Amazon, and even Domino's.
While also buying about $2.65 billion in Delta Airlines, which is an interesting side note.
Right, but then you look across the street at Druckenmiller's Duquesne family office. The data shows they sold off all 385,000 of their Alphabet shares.
And what's wild about that is they just bought a ton of them in the previous quarter.
Right, so they bought in and then immediately dumped the whole thing. So to understand that, we need context on Alphabet as of today, May 16th, 2026.
Right, so let's look at the numbers. Alphabet is trading at around $396.78.
Okay.
It's got a massive $4.81 trillion market cap and a price-to-earnings ratio, or PE, of 30.3.
Okay, let's slow down and translate that for a second for any beginners out there. Let's start with these filings. When we say filings, we are talking about a 13F filing, right?
Yes, a 13F, it's basically a quarterly report card. Any big fund managing over $100 million has to show the government what U.S. stocks they own.
So it lets us regular folks peek over the fence at what the billionaires are holding.
Exactly. But it's delayed. It's a snapshot from the end of March, and we're just seeing it now in mid-May.
Got it. And what about that PE ratio, 30.3? What does that actually mean?
Basically, the price-to-earnings ratio tells you how expensive a stock is relative to its actual profits. A 30.3 PE means you are paying over $30 for every $1 of profit the company makes.
So that's not cheap.
No, it's not cheap at all. You are paying a premium. Investors are willing to pay that high price because everyone expects them to grow massively.
Let me try an analogy here. Tell me if this makes sense.
Go for it.
Imagine two expert real estate investors looking at a $1 million house.
Yeah.
One buys it immediately and the other runs away.
I like where this is going.
It's not that the house is a mystery, right? They both see the same roof and plumbing. It's that one investor wants to live there for 10 years and raise a family, and the other wanted to flip it in 3 months and realized the profit margin wasn't there.
That is a perfect way to look at it. What's fascinating here is that Alphabet is no longer some cheap, ignored tech stock.
Right. Everybody knows about Google.
Exactly. All the expectations around AI, cloud computing, and their search dominance, it's already baked into that high price tag.
So it's priced for perfection. Which brings us to the Berkshire philosophy. Because if the stock is fully priced and kind of expensive, why did a historically cautious, value-driven company like Berkshire just back up the truck to buy it?
Well, according to recent analysis, this might not even be Warren Buffett's direct move anymore.
Oh, really? Who is making the call then?
Remember, Todd Combs left for JP Morgan back in late 2025. So Greg Abel's influence is really growing. This is very much a post-Buffett strategy at Berkshire.
That makes sense. But they sold traditional high-margin cash cows to fund this. They sold Visa and MasterCard.
Which is huge because those are usually seen as untouchable.
Right. I mean, wait, aren't credit card companies the ultimate safe toll booths? Like, every time you swipe for coffee, they take a cut?
Right.
Why trade a reliable toll booth for a tech company spending billions on AI?
Because Berkshire sees Alphabet as the new toll booth, a sort of digital utility.
A digital utility. Okay, explain that.
Berkshire doesn't view Alphabet as some speculative AI gamble. They see a cash-flowing machine. Think about search, YouTube, Android, Google Cloud.
They basically own the internet infrastructure.
Exactly. They have a massive economic moat, a competitive advantage that protects them. Meanwhile, Visa and MasterCard are actually facing huge threats right now.
From what? Like crypto?
Yeah, stable coins, rapid fintech advancements, and massive government regulation trying to slash swipe fees. The old toll booth is under attack.
Wow, okay. So they are ditching the plastic credit card toll booth for the digital internet toll booth.
Right. And yes, AI infrastructure, what we call CapEx or capital expenditures, costs an absolute fortune to build.
I mean, they are buying thousands of chips, building data centers.
Building literal power grids. But Alphabet has the massive existing ad revenue from Google and YouTube to pay for it without going bankrupt. Berkshire is playing a 5 to 10-year game here.
Okay, so Berkshire thinks Alphabet is a 10-year digital fortress. So what in the world did Stanley Druckenmiller see that made him smash the sell button?
Well, Druckenmiller is a macro trader.
Meaning he looks at the big economic picture.
Exactly. He doesn't hold things forever. He reacts to the economic weather. And right now, the weather is incredibly risky.
Especially with the current Trump administration, right? There's a specific economic environment happening.
Yes. Between trade policies and persistent inflation, the Federal Reserve is keeping interest rates elevated. The data shows 30-year U.S. Treasury bond yields are hitting 5%.
And 5% is a big deal. Let's translate this for the listener, because why high interest rates hurt tech stocks is such a crucial concept.
It really is the key to understanding the market right now.
I always think of interest rates as financial gravity. Like if you can get a guaranteed 5% return from a boring, totally safe government bond, why risk your money on a tech stock?
Unless that tech stock is going to grow incredibly fast.
Right. The higher that interest rate goes, the heavier the gravity pulling down tech stock prices.
That is exactly what Druckenmiller saw. He bought Alphabet a few months ago for an AI momentum trade.
He rode the wave up.
Yes, and now he is looking at that gravity, looking at the high price, and taking his chips off the table. He rotated into biotech and healthcare.
Like Nuvation Bio and Caris Life Sciences, based on the reports.
Right, sectors that are less correlated with all this AI hype. He's playing a 3 to 12-month game. He's not saying Google is a bad company.
He's just saying the timing and the price are wrong for his specific short-term strategy.
Exactly.
So we now see why they act differently. And honestly, here's where it gets really interesting, because it reveals the true nature of Alphabet right now. It's like a company with a split personality.
A double-edged sword, definitely.
On one hand, according to the reports, Alphabet is an absolute AI winner. They have Gemini, Google Cloud, and they are building their own TPU chips to rival NVIDIA.
Which is a massive advantage. They don't have to rely entirely on NVIDIA for hardware.
But on the other hand, Alphabet is facing these crushing AI costs.
Right.
They're literally issuing global bonds, borrowing money just to pay for data centers.
And Wall Street is totally split on this. We saw massive funds like TCI and Third Point recently buy millions of Alphabet shares while dumping Microsoft.
Seeing Google as the better relative value.
Right. But it's a terrifying transition for them.
Which brings me to a huge question I have. If they are the undisputed kings of search, isn't AI actually a massive threat to them?
Oh, it's their biggest nightmare.
Because think about it. If an AI just gives you the answer immediately, nobody clicks on the blue links. And if nobody clicks on the links, nobody clicks on the ads that make Google all their money.
I enthusiastically agree with you. It's the classic innovator's dilemma. If we connect this to the bigger picture, the cost of generating an AI answer is vastly more expensive than a traditional search.
Like 10 or 20 times more expensive, right?
At least. So Alphabet has to spend billions on AI, driving up their costs, just to defend its current monopoly from rivals like OpenAI and Microsoft.
Because if they don't give you the AI answer, ChatGPT will.
Exactly. It's a defensive play as much as an offensive one. They have to spend a fortune just to avoid becoming obsolete.
Okay, so we've solved the billionaire mystery. Berkshire is buying the 10-year utility. Druckenmiller is dodging the 6-month gravity of interest rates.
Which is a great summary of the situation.
But how does the everyday listener actually use this information for their own retirement or brokerage account? What's the takeaway here?
Well, the first big takeaway, and I cannot stress this enough, is never blindly copy 13F filings.
Yes. Do not just copy-paste their portfolios.
By the time the public sees these filings, the data is 45 days old. Druckenmiller might have already bought the stock back yesterday, for all we know.
That is such a good point. It's a delayed snapshot.
Exactly. And secondly, you have to check your overlap.
What do you mean by overlap?
Well, if you own an S&P 500 index fund, which a lot of beginner investors do, you already own a lot of Alphabet. It's a core holding in almost every major fund.
So you are already taking on both the massive potential of AI and the massive financial burden of building it, just by holding a basic index fund.
Right. You might be more exposed to Google than you think.
So for you listening right now, you need to ask yourself, are you investing like Berkshire, looking 10 years down the road, or are you trading like Druckenmiller, worried about the next 6 months of interest rates? You really have to know your own game.
And this raises an important question. People often forget that a great company doesn't always mean a great start price in the short term.
Right. The business can be doing fine, but the stock can still tank.
Exactly. You have to watch if Alphabet's massive spending on all these AI data centers actually turns into real profits over the next 2 to 3 years.
Or if it just permanently crushes their profit margins.
Which is the trillion-dollar question right now.
So what does this all mean? Next time you use a search engine or watch a YouTube video, ask yourself, are you looking at an unstoppable digital utility or a tech giant trapped in the most expensive arms race in human history? The answer might just define the next decade of the stock market. Don't forget to subscribe and hit that like button.